Hey everyone, Mortgage Nerd here. I want to talk to you a little bit about interest rates, inflation, and deflation. What is this that we're looking at here? So interest rates are coming down. I've been saying this for a couple weeks now. This was the high point after the CPI and everybody flipped out, and the Fed raised the Fed fund rate by 75 basis points, almost 1%. And since then, mortgage bonds have been rising, which is good. There's a little blip here, 10-year Treasury coming down, but you can see now we're breaking through some important levels. I'm going to tell you why. Remember, inflation is the arch enemy of mortgage bonds, of mortgage rates. So now the 10-year Treasury is coming down, broken through some important levels, closed below these levels yesterday, and now we're starting after the overnight. It's only 8 a.m., July 1st, breaking through. Look at all this room to go down. That means all this room for rates to continue dropping. Doesn't mean they will, but why is this happening? What's going on? Isn't inflation going crazy and the values are going to crash? Well, let me show you exactly what's going on. The core PCE, that's the personal consumption expenditure year over year, core strips out medical and housing and things like that. So while inflation was at its peak, according to the PCE, which is the Fed's favorite measure of inflation, by the way, ever since the beginning of the year at its peak, it's been dropping. Not the CPI, that's the basket of goods that came out a couple weeks ago and caused everything to go into turmoil. But a lot of people have been saying inflation may be at its peak. A lot of other people have been saying we're probably going to see deflation coming up here by the end of the year. What does that mean? That means there's way too much supply, not of housing, of retail stuff. Target, Walmart, all these places. But not only that, shipping containers are sitting for longer than ever in California. They have an oversupply in California, nowhere to send it to. This is Shanghai. This is back in April when they were deep into their lockdowns and all these ships were sitting outside the port. Those are all ships, all of these little dots, ships trying to get in and out of the Shanghai port to deliver stuff throughout the world. So the huge backlog of inventory, which is a big part of what has caused the inflation, is loosening up. As Shanghai opens up, they're kind of going back and forth, vacillating. But either way, when all of that opens up and all that new stuff comes over, there's going to be deflation, which means the value of things is going to start coming down. Might not be cars, might not be real estate, might not be other things, but we are seeing that. And you can see it in the rates. You can see it in the 10-year Treasury. You can see it in the mortgage bonds. So while deflation sounds good because it's the opposite of inflation, but what does that do to the small business owner? The small business owner that has a bunch of inventory that they need to sell that maybe they overpaid for, and now they've got to sell it and cut their prices to get that off their shelves, they're going to get hurt. So we're still not out of this mess, but at least we're seeing some signs of an end of inflation, which is a big reason we're in this mess. And the Fed will likely raise rates anyway next month or this month because we're in July. But at least for mortgage rates, which is what I'm most concerned about, we enter this range up here where we're in the high 4s and 5s on interest rate wise, then I think we'll be in a good place going sideways. Not down here in the mortgage bonds, but up here is a much better place for me and for my clients. So that's the video on rates, inflation, and deflation to start the month of July. Have a great Independence Day. And look at that, right as we're talking, mortgage bonds continue to rise, 10-year Treasury down. So I'll probably be locking some people in here. Maybe I'll wait for others. We'll see. Mortgage Nerd out.